All right, welcome to The Explainer. Today, we're tearing down the middle-class wealth trap and unlocking the sheer, absolute power of compounding. Let's jump right in. So, be honest with yourself for a second. Where exactly does your monthly salary disappear to? I mean, we work incredibly hard, right? Yet, for so many of us, the middle of the month rolls around and we're just waiting. We're anxiously waiting for that next paycheck. You pay the rent, you pay the bills, maybe handle a random emergency, and poof, the money is just gone. There's this brilliantly accurate saying, a middle-class salary is like sand in a fist. The tighter you hold it, the faster it slips away. And man, doesn't that just hit home? You feel like you're gripping your earnings with everything you've got, but the tighter that grip gets, the faster it all slips through your fingers. It's like the money never actually sticks around to work for you. It's basically just a brief tourist visiting your bank account before taking off again. Part 1. 3 friends, 3 paths. To truly understand how to break this frustrating cycle, we're going to look at 3 friends, John, Michael, and David. Now, they grew up in the exact same town, got the exact same engineering degrees, and moved to the big city with the exact same dream of getting rich. But while they shared that exact same starting line, their mindsets, well, they were completely different. One was totally obsessed with spending to look successful, one focused entirely on building long-term assets, and the last was dedicated to creating a foolproof system. Let's start with John. John totally believed that making money meant showing it off immediately. When he landed his first big $30,000 salary, he felt like he'd already won the game. So what did he do? He upgraded his lifestyle to match his new income. We're talking expensive weekend outings, a brand new smartphone on an installment plan, flashy designer clothes. To John, wealth just meant a flashy lifestyle. But here is where it gets crazy. Look at this massive $24,000 figure. That number actually represents John's combined $12,000 premium apartment rent and his $12,000 shiny new car EMI over his budget. That is swallowing almost his entire income before the month even officially begins. He really thought he was upgrading his life, but honestly, he was just strapping himself into this golden cage of debt. Okay, now Michael, on the other hand, took a completely different route. He completely ignored the flashy city life and those expensive downtown apartments. Instead, he moved out to the dusty, completely undeveloped outskirts of town. People literally mocked him. They were asking if he was trying to build a career or settle in a remote village. But Michael wasn't looking at the present at all. He was looking decades into the future. He quietly invested his savings into a cheap, undeveloped plot of land. And over 11 quiet years, he just let time and development do all the heavy lifting. His investment started as an empty dirt plot. By year 5, new roads and schools were popping up. By year 11, it had transformed into a bustling commercial hub. He literally turned a basic $1 million real estate investment into an unbelievable $9 million fortune. He didn't chase quick money. He partnered with time. And then we have David. Now, David didn't want a quick win either. And he actually wasn't interested in real estate speculation. He wanted a bulletproof mathematical system to build wealth through the stock market, because he understood that the stock market is absolutely not a casino. It's a powerful tool for those with patience. He couldn't care less about looking rich right now. He cared about the slow, steady math of compounding. So his secret weapon was the 50-30-20 rule. He completely, rigidly automated his finances. 50% went straight to his basic needs, 30% went to his lifestyle and fun, and no matter what happened, that final 20% slice went straight into his investments via an index fund before he could even see it hit his checking account. Part 2. The Warren Buffett philosophy. This brings us to a massive, fundamental shift in thinking, and it's inspired by one of the greatest investors to ever live, Warren Buffett. He famously said, "Do not save what is left after spending, but spend what is left after saving." The absolute crucial takeaway here is that the order in which you handle your money dictates your entire financial future. I know, it sounds so incredibly simple, right? Almost too simple, but I promise you, it is the exact dividing line between the middle class and the truly wealthy. When you put their mindsets side by side, the stark contrast shows exactly why John was left drowning in debt while David was quietly building a massive empire. John paid everyone else first. He paid his landlord, the car dealership, the fancy restaurants, and just kind of hoped there'd be something left over to save. Spoiler alert, there never was. David, however, paid his future self first, and then happily lived off whatever remained. Moving on to part 3, the 7-3-2 compounding rule. So if David's discipline was the engine of his wealth, this next concept is the high-octane fuel.
It's the hidden mathematical mechanism that turns ordinary, boring monthly savings into life-changing wealth. It's called the 7-3-2 rule. Basically, assuming an average market return of about 10%, your money roughly doubles every 7 years. And most people actually quit investing because they just don't get that wealth requires incredible, almost painful patience right at the very beginning. They want to see the rocket take off immediately, completely ignoring that it takes years just to build the launch pad.
These phases of compounding require immense patience. For those first 7 years, you are just building the base. Honestly, the growth feels incredibly slow, maybe even boring. But then, stick around for years 8 through 10, because that's when you start seeing real, visible, exciting growth. And finally, the magic happens. Those last 2 years, years 11 and 12, that is the exponential jump where your money rockets upward like an airplane finally pulling up off the runway. Let's break those numbers down. In years 1 through 7, a $100,000 portfolio slowly doubles to $200,000. It takes a long time. But by the time you hit those last 2 years, your base is so massive that the 10% interest alone starts generating more cash than your actual day job salary. Seriously, the magic absolutely isn't in the amount you invest. It's entirely in the time you let it bake. Which brings us perfectly to part 4. The power of time and why you must start early. To really prove the power of time to you, let's look at the absolute most dangerous financial mistake you can possibly make. If you start at age 25, investing $5,000 a month for 30 years, you end up with a huge multi-million-dollar fortune, period. But if you wait until you are 35 to start doing the exact same thing, investing for 20 years, your outcome is roughly half the final wealth. Let that sink in. Even with the exact same $5,000 monthly investment and the exact same rock-solid discipline, waiting just 10 years literally slashes your final net worth in half. The sheer, overwhelming reality is just this massive gap that a simple 10-year head start creates. The person who started at 35 has to work twice as hard, take on twice as much risk, and endure twice as much stress just to try and catch up to the person who simply decided to start at 25. Part 5, the final reality checked. So, fast forward to age 36, and the results of our 3 friends' mindsets are pretty much set in stone. The choices they made back in their 20s have completely locked in their realities for their 30s, 40s, and beyond. Michael is now totally financially free. His real estate assets are generating enough rent to cover his entire life. David? He's just 5 years away from total financial independence, just letting his portfolio compound beautifully in the background. And John? Well, John is trapped in 20 more years of car and housing debt. Sure, his salary grew, but his lifestyle and his expenses grew way faster. Remember, your salary isn't the problem. Your financial habits are the problem. And this is the ultimate truth you really need to take away today. You can always negotiate a raise, you can take on a side hustle, you can even take on more investment risk, but you can never, ever buy back lost time. No massive bank loan and no magical salary bump can ever give you back a decade of missed compounding. So I want to leave you with this final provocative thought. I want you to be brutally honest with yourself. Are you John, Michael, or David? Whose path are you actually on right now? And far more importantly, what will you change today to build your own system? Because honestly, the best time to start was yesterday, but the next best time is right now. Decide today to take absolute control of your financial future.